As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. V.S. Ganesh, CEO of Page Industries Limited. Thank you, and over to you, sir.
Thank you so much, and good evening, everyone. It's a pleasure to interact with all of you today, and I do look forward to the session. Today, I'm joined by our CFO, Mr. K. Chandrasekhar. I'm also joined by Mr. Gagan Segar, our President, Channel Sales and Distribution, and by Mr. Rahul Shukla, our Senior Vice President for EBO and LFS. Before I start highlighting the performance for the quarter, I would like to thank once again to all those thousands of women and men in our operating facilities and various markets and stores who have worked very diligently with utmost care by taking all precautions to resist the pandemic and for creating a very safe work environment to all our associates in the factories and to our customers. I would also like to thank all the franchisees, the distributors, the warehouse partners, and all our supply partners in the back end who helped us to cope with the challenging situation. And of course, our thanks also due to our beloved employees of Page.
The conference is now being recorded.
Last quarter. I would also like to thank all of you, the analysts and the investors. You have been our well-wishers and the ones who keep challenging us on the most important things that we should continue to deliver and focus. The quarter itself was a fantastic quarter for us in terms of sales growth. Given the disruption created by the pandemic, we are proud that we outdid our own plans and expectations. Our revenue for Q1 grew by 76%, and by volume it grew by 70% year-on-year, aided by gradual lifting of the lockdown post the second wave, which helped increase footfall in the stores. I'm sure you all know we can't compare these numbers with our last quarter, as it would not be like to like. However, for the sake of record, I would like to tell you that the revenue is 43% lower and volume by 45% quarter on quarter. Of course, as you know, this is mainly because of the fact that we lost almost half of Q1 because of the lockdown. More than 61% of the MD outlets were active at June end. And by the end of June, all our EBOs and LFS were open. Our manufacturing and warehousing facilities have now returned to normalcy, and we are taking all necessary precautions to ensure the safety of all our associates. As regards the market, the sales trend, which has been on an increasing trend since the last year, continues to show that robustness and is looking very bullish, barring the lockdown period. Our branding efforts continue through multiple channels, including online, media, and point of sale. E-commerce continues to be robust. Our kidswear business continues to be a special focus area with very encouraging customer acceptance and feedback. We now have 39 EBOs that are exclusive for Jockey Junior. We have been able to build a separate channel with nearly 200 strong sales force for the juniors business. We have also appointed Jockey Junior specific channel partners across 50 cities. We continue to expand our depth within existing market geographies as well as strengthen distribution in markets which are witnessing expansion of mature retail formats. Jockey is present throughout India in 2,895 cities and towns. We see great potential in the rural, Tier 3 and Tier 4 cities, and we are strengthening our distribution network in a phased manner in these markets with opportunities. We will continue to give our best effort and focus on the core business vertical, that is the men's innerwear, women's innerwear, athleisure, both men's and women, socks and towels, and we are very confident of maintaining growth going forward. We are delighted that our team was able to put together so many innovations in ensuring customer acquisition, in controlling cost, in managing cash, and in bringing the best out of our associates, and in reassuring all our stakeholders that all is getting done. I will now hand over to our CFO, Mr. Chandrasekhar, to give us the Q1 financial results and review. Thank you, and over to you, KC.
Thank you, Ganesh. Welcome once again to the call. Hope I am audible and clear. The Q1 FY22 revenues you would have seen reported at 5015 million. This was 2848 million last year. So, of course, both quarters have been subject to the pandemic. So this is not best performance, but still there is a growth of 76%. So last year, even though half the quarter was affected, and similarly this year also, but we have done well because we have learned and we have been able to mobilize better in this year than in the last year when pandemic was a surprise to all businesses. And of course, the best performance as far as a quarter is concerned is above 8,000 million, as you know, for Page. And the volume was 25.28 million this quarter, which is again a 70% growth. The EBITDA margins are largely affected by the lower revenues at 6.8, again compares with minus 12.2 of Q1 FY21. And then, but then we delivered 19.3 in the preceding quarter, Q4 FY21. So the EBITDA margins are lower mainly on account of wages, selling overhead and corporate overheads under absorption. About 6% from wages and selling overheads by about 2% and the corporate overheads by 4%. So that explains the EBITDA margins being lower. We typically report and compare the gross margins, and the gross margins for the quarter Q1 FY22 is 33.2%, which compares with about 39.3% of last year, which is FY21. Again, as I said, due to the lower absorption of wages by about 6%. You would be asking about the raw material prices for sure. The raw material prices are holding around 44 to 46% of revenue. This has been more or less in line with the past quarters because, as you know, with the increase in raw material cost, we also increase the selling prices year on year. So it remains around similar percentage of revenue. We did, however, see about a 2.8% increase in the RM cost impact in Q1. And the forecast going forward is about 5 to 7%. But what I hear is the prices are weakening now, and we have to wait and watch in the rest of the year. The Q1 FY22 profit after tax is down by about 91% quarter on quarter, but then up by 128% compared with FY21 Q1. It's about 109 million, and the margin is at 2.2%. The cash equivalent compared with the 4347 million of March 21 is down to about 3271 million, mainly on account of lower sales and collections. But we are maintaining a close watch and keeping all the OPEX under control in Q1. Business is resuming to normalcy. April we did like 19% EBITDA, and but then May and June wasn't that good. July is somewhat similar to April, so we are back on back on track. The net working capital is about 5,100 billion, which is the same as March. The only thing is the cash is now replaced with inventory, where there is a strategic build-up of inventory. So that is as far as the financial update is concerned. Can we now open the floor for Q&A?
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Gupta from Goldman Sachs. Please go ahead.
Hi, good evening, everyone. A couple of questions. First, on the volume growth of 70%, there are too many moving parts in the quarters. If you could just help us understand at least which segments grew more than 72 and which ones grew less than 72, it will be very helpful.
Yes, Aditya, if you are looking at the volume growth against last Q1, this Q1, every segment had a tremendous growth in volume, and we are continuing to see similar growth. All categories are growing. However, the bias is more towards that leisure, obviously with work from home. So the share of the accelerated growth is happening on that side of the business. And we are also seeing very good traction on the women's innerwear and the leisure side of the business as well.
Got it. Very helpful. Maybe it's a follow-up on this now with, let's say, vaccination picking up, hopefully people getting back to offices sometime this year, and with malls and other department stores also opening up hopefully by the end of the year. How do you, from a competitive scenario, how has the competitive positioning improved for the brand over the last 12 to 18 months? And how do you think competitive activity is going to be when everything opens up and people also start going back to offices?
Aditya, how I look at it, I think we managed to have quite a lot of customer acquisition during this time, because these are times when customers will always look for trusted brands with good value for money proposition. And quite a lot also depends on how robust your supply chain is, your product in the marketplace. So in that sense, we were able to gain a lot of ground, and this will help us in the long run. We also very well geared up for e-commerce. It grew tremendously, and from the warehouse, IT, logistics point of view, we were able to augment a lot of resources and become capable. So that also helps us quite a lot. And we have taken a lot of initiatives to ensure growth. So last year, if you see, despite the pandemic, we were able to open more stores. And we opened 14,000 MBOs and 200 EBOs. And that was a tremendous job which we did. And more than 50% of this growth came from Tier 3, 4 cities. So while we are looking at the productivity improvement in our current stores, we have also been expanding our footprint, and the bias towards more rural market with a lot of dedicated leadership and resources being put towards it is helping us quite a lot. And this momentum and trust will continue.
Got it. Very helpful.
Yes.
And just one last question from me. On the gross margins, which is reported in the P&L, right? So last year's first quarter, there was a significant dip from 59% in March or fourth quarter 20 to a 48% in first quarter of 21. And a lot of this was attributed to obviously under absorption of overheads, manufacturing overheads rather, due to the impact of the lockdown. Now, but this time around, the gross margins as reported in the P&L have actually held up pretty flat quarter on quarter. Now, I would have assumed that a similar kind of an under absorption of overheads would have happened this quarter also, like last time around, right? The magnitude might not have been similar, but there should have been some quarter on quarter compression over here, or is there something that I'm missing over here?
Yeah, typically, Aditya, good question again. I think it will answer the questions for many people. The gross margin, maybe you're looking at what is published. If you had a chance to go through the earnings presentation, the gross margin I did mention in my first introduction, it's about 33.2% after the subcontract costs and the other manufacturing costs. So it is about 6% down from the typical historical gross margin about 39 to 40%. So it's about 6% down, mainly due to the wages under absorption. And that would again, when the volumes are back to normal, it should go back in the same range because we increase the selling price in proportion with any of the cost inputs, including raw material. So we may try to achieve around 20 to 21% EBITDA margin. So this should restore even if you go back to FY21, in all the months where there was no lockdown, we had exceeded an EBITDA margin of about 21% in all the months, excluding the lockdown period. So this is something which is sustained in terms of our approach to the business.
Okay, got it. Perfectly clear. Thank you.
Thanks.
Thank you. The next question is from the line of Avi Mehta from Macquarie. Please go ahead.
Hi, team. Hi, sir. Thanks a lot for this opportunity. I wanted to kind of, understand the comment that you made in the start about July being back to April levels. Would you be able to give a sense versus pre-COVID? How are we back to pre-COVID in a sense? If I were to take 2 years back sales number, we are back to that number now, or are we seeing a growth from that number? Kind of give us some.
It's early to call because even July was disrupted in some manner. So I would really wait for Q2 to come out to be able to make a comment. Because even within Q1 was up and down.
Okay. How was June? Maybe if it is possible to give us a sense on with the lockdown still being there, how the impact was. Would we be able to get some sense on that, sir? Was it 60%, 70%, 80% of the normal, or how would you, not an exact number, but just a range, sir?
Like in terms of volume, April was about 12 million, May was about 4, and June was about 9. So that adds up. So June was like twice of May, but it's not close to anywhere being where it should be.
Okay. And there is no seasonality over here, right? Because of the price increase that April typically is higher. It was not like that. It is just because.
No, I mean, it's been a tough time, and also April and May have been quite tough on everyone, on the personal front also. So there is no seasonality as such, but I think June was a bit of a recovery and July is better, but we really need to give it a little more time.
Okay, sir. And when you say, sir, still restrictions, is it specific geography that you are kind of would like to call out, which is wherein the pressure is there, sir, still? Or are we now completely out, sir, in terms of restrictions? Or still some parts are under, Kerala is, but is that a large chunk for us? Is that what you are kind of alluding to when you say things are not yet normal?
I think Gagan can give a very good answer. Gagan.
Mostly things have opened up, but then yes, we still are impact. Kerala, and it is definitely it contributes to our top line. So we still have to wait, I think, but overall we are very positive. Things have opened up mostly all across, but except barring couple of states. So that's why we are confident going forward.
Okay, sir. Sir, and second, just on a conceptual basis, you highlighted that RM is back to 44 to 46% of sales. because of the price increases that you have taken in June, right, sir? Is that correct, sir?
Yeah. Yeah.
And hence, would it be fair to expect if when things normalize, we would move back to what we saw in the second quarter, third quarter of last year? Is that a fair way to look at margins?
Absolutely. Absolutely. In fact, I had mentioned to you that even in FY21, we had delivered upwards of 21% EBITDA margins in all the months, which were considered normal. So that is how we always operate.
Okay, sir. Perfect. That's all from my side. I'll come back in the answer for the question. Thank you very much, sir.
Thanks, Abhi.
Thank you. The next question is from the line of Nihal Jam from Edelweiss. Please go ahead.
Yes, sir. Thank you so much and good evening to the management. Sir, two questions from my side. You obviously mentioned in the last call that production was shut till 7 June and I think from April. So is it that there was actually an issue with the availability of product that has impacted sales, and how is it that we managed, whether it has been via inventory or we did a ramp up in production after June? If you could just give us an post on that.
Yes. So, Mr. Nitin, we lost 48 days in manufacturing. That is true, but we had inventory, and you also know we also have a strong outsourcing. So we outsource close to 1/3 of our products, and we are always, as a risk mitigation, we always ensure these facilities across India are not concentrated to one region. So that did help us to keep the supplies on. Didn't create much disruption. We also had adequate raw material safety stock built up. We even now are holding enough raw material stock so that we can quickly ramp up capacities when required. And these stocks were also used to support our outsourced vendor partners. On the in-house manufacturing, the moment we opened up, we were able to scale up capacity because we went into shift operations. So now all our facilities are working in 2 shifts. Even though the government allows 100% people can come and work, we are keeping less than that. We are keeping 50 to 55% people on a given point of time working in 2 shifts. So this has helped us in not only maintaining safety and social distancing and health and safety of our associates, but also get into normalcy as regards the capacities are concerned. We also worked hard on the outsourcing side and have increased our outsourcing capacity by close to 50% from where we were 6 months back. So the supply chain is well poised to accelerate supplies and build inventories.
That's helpful, sir. The second question was that the same time last year when COVID impacted, what we saw as a trend, and it was alluded also last year, was that there was a sharp improvement in demand, I think especially from the athleisure side, where despite losing out the first quarter, the strong demand momentum saw us making up the entire revenues in the rest of the year. I just wanted to get a sense, and I'm specifically, speaking more from the athleisure side, that are we seeing that once things have normalized, that the pent-up demand or the ramp-up in the athleisure segment is as strong as last year?
Yes, I firmly believe it will continue to be robust because this is an opportunity where people discovered us and understood our product much better, its value for money, quality, fit, and therefore I can see much more loyalty and from our customers on the athleisure side. So in that sense, I think this was a good discovery for our consumers and it was a great opportunity for us. And when I see the way the product is received in the market, we are going to be the leading and most trusted athleisure brand of India going forward. That is the way things are moving. So I do have a very bullish outlook as far as athleisure is concerned.
Fair enough. Before I sign off, could you give the average price hike that you've taken to cover the RM cost, maybe versus last year and even on a Q2 basis if there's anything higher? And I'll be done. Thank you.
Yes. So the RM price hikes has been more or less similar to what we have done in the previous years. We usually touch prices anywhere between 3.5% to 5%. It depends on the product. So overall, we have been in that range, and we always, this year also, we were able to continue that because even though the raw material prices went up, we took a lot of cost control measures. As I told you in my beginning statement, we were virtually having a zero-based budget. We were concentrating on every spend, and we were able to cut costs, even though we were very, very careful on the people side. We maintained all our operators, all our associates, all our managers. There was no downsizing. We paid everybody in full. So we took the right measures. We were always looking at need to have expenditures with people first. So the cost controls which finance brought in also helped us in a great extent to mitigate some of the impact of raw material price increase. So this helped us to keep the usual normal price increase despite the raw material creating a lot of pressure as far as prices are concerned.
Thank you.
Thank you. The next question is from the line of Himanshu Nair from Yes Securities. Please go ahead.
Yeah, good evening, sir, and thanks for taking my question. So firstly, on the distribution front, we've seen that we've had very aggressive addition to our MBO and EBO network. So just wanted to understand in terms of the universe, what do we feel is the effective universe of MBOs that we can target and obviously keep growing profitably, and what is the sort of EBO network that we are looking at, if you can give some number there.
Yes. So, there is tremendous scope to improve, and open number of doors. So we are continuing, as you rightly said, we are continuously aggressively expanding that. While we are also looking at productivity increase in our existing stores. And the thrust has been now equally biased more towards, say, Tier 3, 4 cities. We now are also working in the rural market with separate leadership. So you will see more doors opening because of that trust which we are giving. And we are also looking at opportunities in Tier 1 and 2 cities. So it is more distributed in that sense. And we see tremendous scope for growth, both organically and inorganically, as far as that network is concerned. And when it comes to EBO, we have been adding around 200 to 225 to 50 stores year on year, and that will continue, as we see it, because almost all stores are profitable with our expanding product range and more customer acceptance. We need to do this, and therefore we are continuing to have that growth going forward also. Gagan, do you want to add more value to this?
No, absolutely right, as mentioned by CEO. We definitely see a lot of potential as we are expanding our footprint, and 50% of stores which were opened last year were also in Tier 2, Tier 3 cities and rural. And when we look at the throughput of all the new outlets, it's very, very encouraging. Which means the closer we are going to the customer, the retailers also are having a throughput which is making them sustain, and our distribution model is working as we are expanding more and more doors. And I see no reason why for the next couple of years we should not continue to add at this pace.
Okay, understood, sir. Thanks. That gives a lot of clarity. Second one was on the e-commerce bit. Given that in a lot of categories, including yours, we've seen the e-com shares rising, and you also talking about more investments on that front. So just wanted to know what's our current share of sales coming from that channel, and in terms of preparedness for the future, if you can just give us some more color on what all you are doing to further increase the share coming in from that side.
Right. So in FY21, e-com the contribution registered was 7.4% of overall. So that has been a healthy growth for us. That's a growth of around 76%. But we should also keep in mind this is also slightly skewed because the overall sales was not in line with the previous year. So as a percentage, this can look a bit exaggerated. However, even in Q1, the growth was 19%. The contribution is 19% actually, and therefore the year-on-year growth of e-com is, I can say, 2.5x, 248% to be precise. So e-com continues to be a fast-growing channel because of the pandemic, and I'm confident that e-com business will be further scaled up in the coming year because I see the buying pattern of our consumers has changed forever, and this habit say to buy from online. So we will continue to invest. Besides having our own e-com portal, we have also tied up with major online players like Amazon, Myntra, Zivame, Paytm, Flipkart. So this will definitely help us to accelerate growth in the coming years, and in fact in even the coming months.
Right. So just one follow-up. Does it impact our margins in any way? Are the margins different for this channel of sales or not really?
Not really. Through jockeyindia.com, of course, there's a marginal, we have a marginal gain, but overall, if you look at it, there will not be any adverse impact onto the margin.
Understood. Got it, sir. That's it from my side. Thanks and all the best to you.
Thank you. The next question is from the line of Aditya Soman from Goldman Sachs. Please go ahead.
Hi, good evening. Just one follow-up question. I think when you were talking about July earlier, you were talking about margins, right, and not top line, about margins being back to April levels. Did I get you right?
Actually, July, what I said was July is also looking good. We didn't talk any specific numbers there. What we said is, the demand and the appetite for our products continues to be very good, and July has been a good month for us. We may not be able to talk about specific numbers there because, as Mr. Chandrasekhar rightly said, we have to wait for the quarter to end to look at the numbers.
Correct. No, I think I was just picking on your comment you made earlier that July margins are similar to April at 19%, but that's okay. And secondly,
you're right, Aditya, in the sense that in terms of volume, we have seen July. So we I think that it should be similar to April. But again, the full cost will get captured during the quarter. So we'll have to see.
Fair enough. No, I think that's very fair and clear. And my second just broader question, just in terms of what's happening with men's innerwear, because I think you again called out that obviously women's innerwear and athleisure is probably better than the segment average. Men's innerwear has been a bit sluggish now for if you were to compare it with sort of a pre-COVID level for some time. When do you expect to see sort of growth in men's innerwear? Would that be from 2Q or 3Q, or do you think 2Q and 3Q base is tough because we had a significant pent-up demand last year?
Well, men's innerwear actually has grown. There is no bit of growth as far as men's innerwear is concerned. The only thing is with the changing demand pattern, I can say the growth was more accelerated in the athleisure side of the business. Doesn't mean men's innerwear it did grow, and it continues to grow. And we are also taking a lot of initiatives to penetrate more into the market. So as we discussed some time back, that we open more doors, especially in Tier 3 and 4. That should also help us quite a lot to push men's innerwear. and in the rural market also, because those are markets where some of the economy brands have had a good footprint, and we are not. Our presence can be better, I can put it that way, So we are improving our presence there, and that will really help the non-silverware business as we move forward.
Mr. Soman, you have any more questions?
Yeah, sorry, I was on mute. Just in terms of last question for me, just in terms of effective price increase, how much would that have been at a sort of portfolio level in 1Q, and how much should we expect going forward?
Casey, can you share the exact percentage of price increase?
Yeah, we did about around 4%. And going forward, if you're asking about going forward, then we're just watching the RM prices. We have a fair fix of the OPEX. And touch wood, we hope that, there is no lockdown again. And with people getting vaccinated, we should get nearly normal business in the rest of the month. That being the case, it would be a function of the RM price increase. And of course, if RM goes up hypothetically by 6%, then we would only need to increase price by 3%. And of course, minus all the other OPEX, work that we are doing. So we really have to. But historically, Aditya, we have not increased prices beyond 3 to 4%. It comes out as a balancing figure when we look at projecting 21% EBITDA margin.
Understand now. Thanks for that clarity, and wishing you all the best.
Thank you. The next question is from the line of Bhargav from Kotak Mutual Fund. Please go ahead.
Yeah, good evening, team, and thank you for the opportunity. My first question is that in your opening remarks, you mentioned that you have been expanding distribution in the rural areas and tier 3, tier 4 cities. Now, given these markets are extremely price sensitive, how do we ensure that we succeed in these markets?
Mr. Bhargav, actually, Jockey, we have always ensured that we give a very good value for money proposition to our consumers. And we are also picking and choosing the products which are right for those markets from the current portfolio. And of course, if we are here to develop any new products for those markets, we will always make sure that it continues to be a high quality product without no compromise to quality and value for money proposition. So, Gagan, you want to also throw some light on this?
So, our contribution from the smaller towns still is about 50%, and that shows us the potential that we have. And as I mentioned, last year we took a bet on expanding the outlets, and when we saw the throughput per outlet, as I mentioned earlier, it was very, very, overwhelming in terms of the numbers that we saw. So that shows us the potential of, that there is a Jockey customer even in these towns. And while we are a premium brand, but obviously, we are still affordable premium brand, and a lot of NCC/AB population, they stay in these towns. And normally when they were to buy Jockey, when they come to the bigger town is when they would buy. That is the kind of feedback that we got. But as we are, expanding more into these territories, and also the reverse migration now from metros to the smaller towns post the pandemic because of work from home. So these are the Jockey customers who used to be there in metros, and they have gone back as well to the smaller towns. So the result has been, as I said, pretty healthy. That what we have seen in the last 1 year. In Q1 also, 50% of the outlets that we have opened have been opened in these smaller towns. And our current portfolio itself is giving us a lot of encouraging results. While we will look at maybe if it warrants maybe looking at products for the smaller markets, then we will look at it. But currently, from the current portfolio that we have, we are getting very encouraging results from all these outlets.
So is it possible to call out which stage would these be where we are sort of opening up new stores in the tier 2, tier 4 cities?
Could you ask this question again, please?
I'm saying that is it possible to call out a few states where you are sort of trying to penetrate in this tier 3, tier 4 cities?
Yeah, so we have expanded majorly in center. We have expanded in UP, Maharashtra, Bengal, Rajasthan. These are the states where we have, expanded. Though it's everywhere, but these are the states where we have had majority of the expansion.
And my second question is on your significant pace of opening new EBOs, almost 250 EBOs every year. Now, when we talk to these MBO channel partners of yours, they many times are scared with these new EBOs coming up nearby their stores because essentially it's very difficult to see a company trying to succeed both in the retail as well as sort of distribution channel. Now, what is your rationale? I mean, why should Page sort of expand both to the EBO route as well as to the MBO route? I mean, don't you think it could sort of cannibalize the sales of the MBOs?
I think, Rahul, you want to take that?
Yeah, Mr. Bhargav. Actually, all these channels, the MBOs as well as EBOs, are quite synergetic in nature. The role of the EBOs is not only to offer the entire portfolio of products that the brand offers, but also it helps in building the brand imagery in the minds of consumers who are already loyal to the brand, and hence they would probably come to the EBO. But there's a very large consumer base, which is the traditional customers who still want to shop from the MBO environment, evaluating the various brands and all that. And for these kind of consumers, having an EBO actually rubs off a positive imagery when they buy from the MBOs. It helps the MBOs in improving the jockey sales of the stores. So I think both these channels are synergetic and they quite help each other in improving the sales.
And in terms of collection, is it very, very different between both the channels, or it's probably similar?
Sorry?
In terms of product collection, is it similar in both the channels, or it is quite different in EBO and MBO?
Oh, it would be quite different. There would be, of course, there would be an overlap because they're all part of the array of products the jockey offers. But they probably be operating in a different portfolio of products or the assortment of products. For EBOs, every catchment is actually a unique catchment, and we have a very innovative assortment creation process, which ensures that every store has its own unique assortment, which may be different from the MBOs. They might be working with a different target segment, more traditional customer, more mass market customers, whereas more premium customers might be towards the EBO side. So there would be a little division.
Okay, thanks a lot for your replies and all the very best.
Thank you. Before we take the next question, a reminder to the participants, please limit your questions to 2 per participant. Should you have any follow-up, may we request you to rejoin the queue. The next question is from the line of Gaurav Jogani from Axis Capital. Please go ahead.
Thank you for taking the question, sir. So my first question is with regards to the sharp expansion in the MBO outlet that you have done. So we have expanded approximately 20,000 MBO outlets over the past 2 years. While I understand, that there has been this pandemic over the past 1.5, 2 years, because of which business have been impacted. But once, things get normalized, do you expect a sharp jump up in the sales because of the throughput in these outlets also getting normalized to pre-COVID levels? So any statement that you can give on that?
Gagan, you want to answer that?
Throughput, whether it would increase in the existing outlets or the new outlets?
So my point is that with the 60,000 outlets, we were doing 2,800 odd crores of sales pre-pandemic. Now with the additional 20,000 outlets that you have added, I do understand that during this pandemic the sales were impacted in the older ones as well. But once things normalize, even if the base outlet goes to the older levels, and would you expect the incremental outputs then coming through this, then taking this total sales overall up?
Oh yes, distribution always works that way. While you expand the distribution, you will also it's an ease to the existing customer who travels to outlet which keeps your product. But at the same time, you acquire new products also, new customers also who come to that outlet. So as things normalize, we are very confident that our existing outlets will definitely pick up, like the high street ones where customers, footfall had gone down. But at the same time, the new ones which we opened up, those will continue to have repeat customers coming in. So overall, I think we are in a sweet spot there. Existing outlets throughput also we expect to increase, and the new doors that we open, they will continue to give us revenue. We are very confident.
So in that case, could we see a sharp pickup in sales going ahead the next time?
So I would say yes, definitely it will lead to an incremental sale. But as you open more doors, it also has to do with incremental sales and also better service to the customer, that you go nearer the customer. So both ways, it will give us incremental sales, but more customer satisfaction. So both will go hand in hand. So I would say the truth is somewhere in between. We will get incremental sales, but the distribution expansion is also towards servicing the customer by going near to him. But yes, to answer your question, definitely we will see incremental sales coming in.
Thanks. The next question is with regards to the rural outlet that you were just mentioning to the previous participants. So you mentioned that the 15% contribution is now from these rural outlets, right? 15?
Yes, rural contributes, the definition of rural is, I would say that the tier 2, 3 cities and below and rural combined give us around 50% of our revenue. And pure rural would be somewhere lesser than that.
So, I'm sorry,
will not be that much.
So it is 50. So I'm just the voice 15 or 50?
50 comes from tier 2, 3, 4 and rural.
Sure.
When it comes to metro and tier 1, that's 50%. Yeah.
So also the last one from my end is that in that case, when you extend more to this tier 3, 4 towns, would you also expect the throughput per store might go down because these outlets, while they might give a good ROI per outlet, but the throughut might be lower per store basis versus the tier 1 cities?
Throughput overall per outlet would not be lower because the number of outlets that you will open in a smaller town would be relatively less. But when you look at a metro, because of the high density of population, the number of outlets would be more. So when you compare to a bigger city, the throughput definitely is lesser in the smaller towns. But overall, it is still not, it is comparable to an extent. It might be 20% lesser, 30% lesser compared to metros. But the sheer number of outlets would be less. So the number of players themselves are less, who will be keeping the product because of the density of population.
Sure, sir. Thank you.
Yeah, and I just wanted to also clarify, since you asked so many questions about the rural. Sometimes, the definition of rural can vary from brand to brand. They may classify it differently. For us in Page, rural means any town with $50,000 population.
Should we move to the next question?
Yeah, I'm done. Thank you.
Thank you. The next question is from the line of Tejas Shah from Spark Capital. Please go ahead.
Hi, thanks for the opportunity. So my question pertains to the relative pricing index. So we have been very strong on making pricing intervention, as you mentioned, every year 3.5%, 4%. Now that strategy was going well till FY17-18 when we are growing revenue as well, despite having such a strong pricing actions. But last 2 years, that trade-off has not worked out. So just wanted to understand where do we stand on relative pricing index versus other brands in the men's innerwear in particular? Hello.
Yes. So, as far as pricing is concerned, if you are referring to EBITDA, we are always, with the price increase, it has worked out beautifully for us. You might have seen a different number because of the lockdowns. If you take the months where we have worked with normalcy without lockdowns, we always achieved 21 or 21 plus EBITDA in all the months in which there were no lockdowns. So it continues to work very well for us. And compared to competition, okay, there are two categories. One is the economy brands, and we are not in that space. So we can't directly compare with the economy brands. However, I can say our price starts where their price ends most of the time, for most of our products in men's innerwear. But the absolute rupee increase will not be much for the consumer. It can mean 20 or 30 rupees for the end consumer. But we always make sure as a brand that our prices are in line with the quality of the product, and it's a good value proposition for our consumers. And we always focus on that, and that's our core value with which we want to build the product around. So we will continue to focus on that and give a good value proposition. Absolutely no doubt about it. And when it comes to certain other brands, which may be directly in the same market as we are, I think the prices will be very similar, or in many cases there may be 20, 30 rupees more than us. So I don't see any price pressure in that sense, as far as competitiveness is concerned. We continue to be a, value for money proposition.
Sure. So, sir, that was precisely my question, that for us, throughout our listed history, in our pricing strategy, somewhere explicitly or implicitly, the goal seek function has been this 22% margin. And that worked beautifully because revenue also kept on responding very well to that strategy. Now, for last 2-3 years, we are seeing that somehow the growth is not coming through, and particularly 50% of our business, which is men's innerwear, it is not responding. So, just wanted to know, is it a category level issue? Because the other men's innerwear player, obviously no way comparison to what positioning Page has or Jockey's products have. But do you think that somewhere that 20-22%, which we keep on as a goal seek function for pricing interventions, should be revisited because growth is not responding anymore?
I beg to disagree a bit there, Mr. Shah, right? Because if you see last year, even though we might have degrown by 4%, if you see, we almost lost one quarter. So without one quarter in place, when you degrow only 4%, we are actually grown by 20%. And that's why you saw only a -4. So in that sense, if I see the other months, that's exactly what I was telling you some time back. If you see the other 9 months where we worked with normalcy, we grew. In fact, we had our history's best Q3, and the second best quarter was Q4 last year. So it was phenomenal. And that shows the potential to grow, and we actually grew in those 2 quarters when market went back to normalcy. So we do believe that there is no pressure for us to increase the growth, and we are very, very optimistic about it. And our products are very well received. And if you also see, we also added many other ranges now. We are in early days as far as juniors is concerned. And there is a tremendous growth possible on the junior business. So the athleisure business also, if you see as a percentage of market share, we are in single digits. So there's a tremendous scope for growth on the athleisure side of the business as well. So, and as Gagan rightly said, rural is something which we are not tapped. So when we go there, that is also an opportunity. So we do see a lot of growth opportunities. And we also upgraded our products. And the feedback from the market is very, very exciting. So we are very, very confident about growth.
Sure, sir. So I'll come back in for follow-up questions. Thanks.
Thank you. The next question is from the line of Bharat Shah from ASK Investment Managers. Please go ahead.
Yeah. Hi. So the question is, I heard saying that e-commerce activity has expanded materially as a percentage of our business, and that channel is working very well. But I have a bit of a mixed feeling about it. Ultimately, all businesses have to be close to customers. And traditional model is being to make a good product, build a brand, put it into distribution channel, and it sells without knowing exactly who the final customer is, what is his behavior. The technology is teaching us that there is a way to know each and every customer, even for a large business. And technology allows you to really know your customer more intimately, what he prefers, what he does, when he buys, why he buys, etc. By putting into more and more e-commerce kind of channels, really our connect with the customer gets snapped. As it is, traditional business models didn't have a very good connect. It was more like a distribution model. But if we continue to be on that path, don't you think that takes you away from the final customer, his motivation, his needs, and why he prefers a particular product compared to others?
Okay. Thank you for asking that. It's a very good question. What I can say is it's not that we are pushing e-commerce business. It is more of a pull. The consumer is obviously preferring the channel, and this is understandable. When you have to be at home and want to get your product, you can't step out. The only way to shop is through e-commerce. So obviously, across sectors, including us, if you see any FMCG, the e-com actually grew and it got accelerated. And this, fortunately, unfortunately, is the new buying habit of a consumer. So we need to be ready to it. However, what you said is also right. By doing that, we should not lose touch with the consumers. So today, the e-commerce is 7.6%. With the growth which we are having, even if e-commerce reach 12% or 15% of the business, predominantly, bulk of our customers will be using the channel or the distribution of the EBO channel. So we will be in touch with them. We will be on the ground, and our ears should be on the ground. So I don't think we lose touch. And in fact, with the new generation through e-com also, the feedbacks are very instant. In fact, we may hear from them more directly. The voice of the consumer is much more loud and clear with the ratings, with the comments which comes. We needn't hear it through distribution or through our channel partners. We can hear it directly from the consumers also. So I would say how we manage it is more important. And we should make use of all the opportunities that present itself. And it's a very good point which you said, and we'll be very conscious of the fact that we always hear the voice of the consumer.
Related to that would be the issue. How exactly are we acquiring data of the customer, actual customer, not just the distribution partner? Through EBOs, through MBOs, and through others, do we have a method and a way and a mindset to kind of get inside the mind of a consumer and get a data so that over the period of time, all that data can be analyzed intelligently, and we can bring a greater proximity and power to the power of proximity to customers? Do we just put it into our EBOs and MBOs, or do we have a means of knowing how exactly they sell and who the buyers are, and do we create any attempt to get data about them?
Yes, sir. So we have various initiatives. So we have teams which are very close to the market to sense the demand, and they see how the demand demand is for our products, and this is mainly sensed through what we hear on the ground, and where our consumers are. So that really helps us. We also make sure that we have the right product at the right place at the right time, so that we know that we are fulfilling those demands. And if there are demand dips, that's a message to us, to the supply side goods. So the auto replenishment system is really kicking in very well, and the auto replenishment system, I'm sure, will help us. And we have quite a lot of sales analytics in place, and we have a very strong sales force on the ground. And they visit the market, they are in touch with the customers, and we continuously monitor that, and they have all the digital enablers to capture data, and this is also supported by a very strong CRM team in our office, and they also collect all these information. Along with that, our business excellence team does all this data mining and takes intelligence out of all the data which is harvested through these channels. So we are armed with all this information, and that is actually what is helping us in coming out with the right products, be it the current products or new launches, and also in making sure that we are continuously improving on having the right product at the right place at the right time.
My second question